can't even imagine peanut brittle and Coke. Like the amount of sugar in your mouth, I can't do it. I'd have to
Oh
be
yeah.
born in the 20s to be able to stomach that.
I don't know this for sure, but I've heard rumor from myself that Warren Buffett has 0% of his real teeth left.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Morning, Skippy. How you do is?
Great. Having
I
some
love that.
trouble with grammar over there?
No, I actually just finished this book called Says Who. It's about grammar. My main takeaway was the purpose of language is to communicate, one to understand another. As long as you understand what I was saying, who cares about the grammar? That's it.
I can get like 90% on board with this take.
There you go. We're
generally, the people that are using encyclopedia words to try and sound smart when no one actually understands what they mean.
Yeah.
That doesn't make
I'm not
any
trying to
sense.
do that.
I
I can't even pronounce. I can't even pronounce cyclopedias.
But Douglas, we talk all the time about how this is a family show. And listen, if my first grader is listening to you talk, writing that on his paper, and his teacher's giving him a bad grade, you got some problems. So, bring it up to third grade level. All right. Hey,
I'll do my gosh darndest. So, got some feedback. Going to try something a bit new today. We're going to lay out what we're going to talk about in the episode so people don't have to guess as we go. And then we might have some tributaries as we go through. We might split off, but there are three main topics for the day. We're going to start off with some listener mail about Berkshire Hathaway and the amount of cash that they have. We're going to hit on the $1.5 billion hack on ETH, and then talk about Pershing Square building the next Berkshire Hathaway. Those are the three main topics. Might be some tributaries. It's going to be fun. As always, listener mail at skippydoogles@gmail.com. Please do that. You can find all your Skippy Doogles information at skippydoogles.com, including the Substack, YouTube, etc. You ready for this?
yeah, hit that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles Show.
So there was this Wall Street Journal piece this week on a topic we'd uncovered a whole bunch. So the content isn't necessarily new, though we'll summarize and give an overview, but it's still worth covering because Berkshire has so much cash, and it's had so much cash for a hot minute, but it has so much cash that people are just like, what the heck do I do with this at this point? First, I'm going to hit the listener mail and the topic of it, or sorry, the text of it. Okay. So the name of this piece is Why is Warren Buffett Hoarding So Much Cash? Very straightforward title for the Wall Street Journal piece. And here's what the content of the listener mail was. I'm looking forward to reading Warren Buffett's letter, but I think this is a lot of words to say the market is overheated and it's tough to find a good buy/hold in this froth. If he was truly despondent about the state of the U.S. economy in the long run, it wouldn't all be in T-bills either, I think. First, what does so much cash mean? You want to give an overview? When we say holding so much cash.
Hold on.
What,
I want to unpack that last point of the listener mail.
okay.
Talk to me about that last sentence, specifically referencing T-bills.
What the sentence is saying is if Warren Buffett didn't believe in America, then why would he be holding, quote unquote, non-risk-free debt? We call it risk-free debt because it's T-bills. But if you're like, America done suck, then why would you be holding the debt of America? That's what the last sentence means.
I have a tangent on that. Do you want to do it now or wait till?
Yeah. Dude, if it's fresh in your mentals.
The one pushback I'd have on the listener mail is that specific point. Even with America's record debt levels and the concerns about turbulence in our political environment and 1,000 other concerns you can have about a potential recession, there's still no better place to park $300 billion to get as close to a risk-free return as you could possibly want. So I didn't read this article as, again, I think the first part of the listener mail is perfectly right. This article is Karen Langley trying to make some conclusions about how Buffett feels based on how much cash he's holding that he's not actually making. Buffett just has a lot of cash, to cut to the chase, because there's not anything great to buy that's large enough to move the needle for him. But we'll talk about that more later. I just would really argue that there's no other place, even if he was bearish on America at the moment, there's no other place to park 300 billion cash.
Sure thing. The point is that when the aggregate view right now is fairly bullish. Maybe when I say right now, maybe not this minute, this day, because there's over the last like month or so, there's been a lot of confusion as to what might happen next. But if you say over the last 3 months, let's just call it and call that now. Generally speaking, folks are like 2025 is going to be up and to the right again for stocks. America. The concentration of Merck is going to be. You're shaking your head and giving me ums. But if you look at what analysts, I know you're going to say who cares about analysts, but if you look at what analysts have said for the S&P 500 this next year, what I'm saying is that the overall take is bullish.
Doogles, you're smarter than that. That's what analysts say every year, except for
Not every
a year
year
that happens to go down, and then they say it's going to go down. All analysts do is say what happened 6 months ago that's going to continue, because they don't want to rock the boat, because they actually have to sell these. They have to sell investments to people.
Okay. How about this one? Cash on hand is at the lowest percentage that it's been in a while for investors.
Yes, that's true.
Okay.
Good.
So bullish.
Good point.
Can I just say bullish? Like, why are you trying to push back on my bullishness?
All right.
Okay, put your bear claws away, bro, Safina. So generally speaking, when that's the case, so even if we just take that 1 point, this is going to hit right on Berkshire. If you take that 1 point, cash at a low for investors, cash at a high as a percentage for Berkshire.
All-time high.
Yeah. So if you just let's take the last sentence there. When you say in the aggregate, people are generally speaking bullish, what does it mean when Berkshire at a minimum is not that bullish right now on investing in equities? And one of the takes could be Berkshire's like, not everything's not as rosy. You know, going straight back to every rose has its thorn. You know what I mean? That could be Buffett right now, eating that peanut brittle, drinking that Coke, singing along to Poison.
Deep breaths over here. Have you ever? I can't even imagine peanut brittle and Coke. Like the amount of sugar in your mouth, I can't do it. I'd have to be born in the 20s to be able to stomach that.
I don't know this for sure, but I've heard rumor from myself that Warren Buffett has 0% of his real teeth left.
Also, did you just call me Brosafina? Because
It took you 2 minutes. It took you 2 minutes to catch up on that.
Digesting that. All right. What this article really means is Karen listens to the show. So shout out Karen, because 3-4 weeks ago, I broke this down. We had the exact graph. Now they took our graph and they made it a bar chart instead of a line graph. But it's Berkshire Hathaway cash as a percentage of total assets, which you don't see much. You often hear the gross dollars. And it's an enlightening graph. We talked about it 4 weeks ago, right? It basically, he's been 18 months early on every major pullback. He's held excess cash, and he currently holds more than he ever has as a percent of assets. Super fascinating. I mean, I point people back to that conversation. Timing this stuff is basically impossible, but he's basically the best there ever is. So this is enlightening for me. And I really like your talking point that you're saying, if you look at, I forget exactly how it's defined, but I think it was like a Fidelity survey. Those investment accounts, cash holdings of asset allocators are at basically historic lows, and Berkshire is at historic highs, right? So that dichotomy is very interesting. I'm going to ride with Buffett here, but the average investor should not be timing the market. The average investor, we talked about this in the premium part of our episode last week. If you're having a hard time sleeping at night because of the way your assets are currently allocated, maybe you need a little more cash. But that's a decision you can't make on a weekly basis. That's a decision you can make every 2 or 3 years at most, right? So you can look at this, you can reevaluate where your cash position currently lives, because the optionality of holding lots of cash, it's a great thing.
Just for funsies though, because the aggregate amount of cash is so large as a percentage, you already hit on it. The aggregate amount is over $300 billion. And why that aggregate amount is important. We 5-6 months ago, for funsies, just said, if it came time to deploy, the market got hit and Berkshire said things are well priced, what is Berkshire going to buy? And this was not in a predictive nature. We were just having fun with it. just to talk about the aggregate amount because you could buy some big companies. So we were like Target, Starbucks, right? Throwing organizations out there. In this piece, Karen does the same. And she mentions, and again, the reason I state this is not in a predictive nature, but it's just to say, wow, that's a lot of cash. John Deere, CVS. Like he can just buy a whole pharmaceutical operation. This is the kind of cash that we're talking about that he has. Like he can go and buy big companies and needs to, maybe not in full, but going back to what you stated, needs to at least buy meaningful stakes in companies of that size to move the needle for Berkshire Hathaway. So this is a lot of money. There was rumor the other day that he was going to buy a third of Broadcom. I don't know if that's true. I didn't check that out. But how amazing would something like that be?
He still needs to buy all of Minnesota in my eyes. 3M, Target. There's another one up there. Like that. Those are the companies that Buffett needs to buy.
He just buys Minnesota.
He totally should just move on up from Nebraska and buy some Minnesota. I can't believe he's not. I can. None of the companies we even mentioned are screaming deals right now. And the title of last episode is Waiting for the Bargains to Get More Bargainy. That's exactly what he's doing.
Yes, that's exactly what he said.
He also sees, we don't have to fully transition now, but he also sees the ability for bank run type things to happen and what that can mean for the value of his cash. Because if you look at any of these metrics on the amount of options trading happening in 2025 versus 2020, yep, or the amount of leverage being used, it seems like all the new ETFs that get issued, a significant portion of them are just your favorite stock with additional leverage. Meb Faber and I were chatting on Twitter this week about someone trying to recreate a public version of private equity and venture capital. And the way they've done this is they take about 2.5 times leverage and then buy fairly traditional business names like Meta. So because the stock market has performed so well for 13-ish years, actually 14-ish years.
Yep.
And because everyone now looks at that as the historical record and thinks that that's what's going to happen, when things go up and to the right, what looks better than up and to the right? Up and to the right with leverage, right? So I think there's this bet that when things unwind, if they unwind steeply, they unwind very quickly, and then there's forced selling that takes place. And that's when the bargains get more bargaining, to use Doogles' language.
That's right. Unwinds twice as fast. You also just made me go back to Warren Buffett's diet and the way you were just talking about that. What's good for you? Peanut brittle. What's better for you? Peanut brittle with Coca-Cola.
And McDonald's for breakfast, obviously.
Yes.
So the best part of this article, love the listener mail. Thanks for sending it in. But the best part of this article is the advertisement on the Wall Street Journal is NetJets, right? So Buffett is paying for articles to be written about, but it's so good. The synergies are so great. And by the way, the NetJets look pretty good because we might have to take that to Omaha just to try it out.
There you go. Love it.
I want to keep it moving. When we talked about this in the pre-show meeting, you said, I know nothing about this. I basically know nothing about this as well. I find it fascinating. We're going to cover it at a high level because it speaks to my point from last week when I say most of crypto is scammy and stupid and not worth talking about on the show. So I understand the contradictory nature of this, but as of Friday of last week, it appears, here's what we can piece together based on fairly reputable sources. But again, the Wall Street Journal doesn't cover this like they cover the Berkshire annual letter. So some of the sources here are a little less shady, or a little more shady. It appears like North Korean hackers found a crypto exchange called Bybit and managed to steal $1.5 billion worth of Ethereum.
Okay.
Now, we've talked about this a bunch on the show. Everything's on chain. So stealing in the crypto world is interesting because a lot of times you can hunt down where the money ends up and potentially, like, they haven't really been able to spend this money yet, but it doesn't live on the exchange. And the best I can tell, Bybit is like a competitor to Coinbase.
Yep.
So what's happened at Bye Bye? Well, everyone has decided to make withdrawals, which makes a ton of sense.
Mhm. What
And
didn't make sense was them making deposits.
yes. And they appear to be in the middle of a mini bank run, which could create forced selling in other cryptos, right? Like the safe holding might be Bitcoin, the safe holding might be stablecoin, and it just cascades from there.
Yep.
The CEO was doing some live streaming, which is another thing that only happens in crypto. Remember when Silicon Valley bank failed effectively?
Yep.
And like Congress was involved in everything. This is no, like some dude turns on his live stream and starts talking about, oh, of course we have the funds to cover these deposits. The reason I find this interesting is mostly because this stuff seems to happen way too much. To use your previous example, could you imagine if, I don't know, a company like MasterCard, like Ethereum's market cap is $330 billion. Could you imagine if they were like, oh, all our Fidelity holders actually that held MasterCard, that money disappeared. It's in North Korea now. We'll try and hunt it down, but we don't really have any recourse here.
No.
Don't buy MasterCard on Fidelity anymore. That's effectively what is happening here.
This world is so shady. I don't know what else to call it.
And I sent you this week. It just relates to I think we call it shady and we move on. But some of the most popular YouTube videos in the investing world these days are, let me find the exact title, the fastest and easiest way to do a rug pull. For those who don't know, that's creating a fake token, marketing a fake token, selling it all to steal money from your investors in the liquidity of that token. It's so bad. Maybe we should maybe we should ban crypto from the show, Doogles.
You mean talking about it?
Kinda.
No. No, come on now. This is a part of the financial infrastructure at this point. We gotta let the people know.
Yeah. And it's all scams.
There we go. It may not all be scams, but the parts that aren't, I haven't heard of yet. I'm just leaving it open for the future. All right, I'm gonna reach in. Can I reach in for the big kahuna of this week?
Yeah.
For me. Pershing Square. Now, we, unrelated to this, last week talked about Bill Ackman. We walked through the annual investor presentation of Pershing Square, highlighted some of the individual investments that Pershing's making. We talked about the historical performance. But now we're going to talk about Pershing for a different reason, because Bill Ackman has come out a couple times and he done said, I'm going to build the next Berkshire Hathaway using Howard Hughes. Small, tiny little history of Berkshire Hathaway. Back in the 1960s, Warren Buffett made an investment in a company called Berkshire Hathaway. It was a textile manufacturing business. It was pretty small, ended up being a bad investment for the operating company. But Warren Buffett then started using Berkshire Hathaway, the corporation, to buy other companies. That then became the Berkshire Hathaway that we know today as a holding company. Really fast history. So Pershing Square owns part of a company called Howard Hughes Corporation.
Mm-hmm.
Howard Hughes Corporation is owned by an organization called Howard Hughes Holding. Pershing is now looking to increase its stake in Howard Hughes to 48% of the total shares outstanding, and to make Howard Hughes Holding the next Berkshire Hathaway. That's the headline. So why are we talking about it right now? This week, there was an hour-long presentation that Bill Ackman walked through with investors on X/Twitter to talk through what this would look like. He talked through the organizational model. He talked through the fee structure. He talked through why Pershing is right to do this, what value they're going to add, talk through a whole bunch of stuff. And that's what I want to hit on. You want to go for a ride with me?
I do. I remember a couple of weeks back when I was saying that it was either Ackman or Einhorn that when he initially raised his fund only raised $3 million and then had a really good first couple of years.
Yep.
And a springboard from there. It is Ackman.
Okay.
Ackman started with $3 million.
This is back in 2004-ish, 20 years ago?
Yeah, that sounds right. I don't know the
Okay.
exact date, but I was able to validate that. So, I mean, not humble beginnings, but he started super small. And now He seems to be on a ploy to conquer the world, Douglas. I don't know that I follow this logic, but I think you're even more skeptical than I am.
I have a lot of feelings. Skepticism is probably a good umbrella, but
Okay.
I have a lot of feelings. What I want to do here before we even get to the feelings, I want to walk through some of the presentation so that people can get the context.
Please.
So one, Howard Hughes Corporation. It's what they call a master plan community. It's a real estate company. They mostly own land.
Mm-hmm.
And so they own a whole bunch of assets that in today's environment, especially, no one's fitting to buy. There isn't a high return on this investment in the short run. And so as a publicly traded company, it has not been performing particularly well over the last few years, last decade, something like that. I don't have the chart right in front of me.
Mm-hmm.
Pershing has been acquiring shares in this company. Now they're looking to bump it up to 48% by putting in $900 million into the organization. What's going to happen on the other side of this? Pershing's management, starting with Bill Ackman, they're going to take over as leadership of the holding company, not as leadership of the corporation. So they're going to be, Bill Ackman will be the CEO of Howard Hughes Holding. The CEO, I think his name's David O'Reilly, will remain the CEO of Howard Hughes Corporation, and that will continue to do its business. And then they'll just keep on adding other businesses under the holding company, a la Berkshire.
Mm-hmm.
All right. This is where things get a little bit fun. So one thing that I know that you believe in is having some skin in the game. When you have funds, when you're running an organization, they've got skin in the game. I got to give that to them. So when you look at the amount of money that is going into Howard Hughes that'll be sitting there, Bill Ackman will have $764 million, him personally, that he's saying in quote unquote look through investment. The rest of the Pershing Square team will have a total of about $500 million. So they have over $1 billion sitting in Pershing Square Group. That is skin in the game. Love that part of it. The part where it starts to get interesting, I'd say, is what is the compensation structure? So you're going to be CEO of this Howard Hughes holding. CEOs make good amount of money. How much you going to make? That's the question. And they said, you know what? As a favor to you all, we will take no cash compensation nor equity compensation for our employee side of Howard Hughes Holding. Meaning every other week, I ain't getting a paycheck. But Ackman ain't getting no paycheck every other week. You don't got to pay me. You ain't got to pay me for that.
Cut to the chase already on this one.
All right. What we will do, though, is we're going to take 1.5% of Howard Hughes Holdings equity market cap. So if Howard Hughes becomes a $10 billion holding, we're going to take 1.5%. It becomes $20 billion, we're going to take double of what that is.
Literally insane. Most good companies pay you a dividend. Maybe they give you 1.5% of their market cap for being a shareholder. They're going to do the exact opposite. Just send us 1.5% every year for an Ackman. Okay. Go ahead.
Okay. So then let's go into the qualification of this. So first, they showed this chart. We hit on the cumulative returns of Pershing against the S&P 500 last week. I'm gonna hit on it again right now for people that didn't hear last week. So the S&P 500 since 2004 has gone up about 8x, 700%. Now, what they did differently in this presentation versus what they did in the presentation from the annual is they showed two other graphs for Pershing. One is they showed Pershing minus performance fees and minus management fees. So here's what that means. So the 1.5%, take that as management fee. That's the management fee. And that's what they charge in Pershing overall for Pershing Square. Then they also charge 16 to 20% incentive performance fee that they take. That's dependent on whatever the return is for the fund. So they showed that graph. If you take out, so net of the 1.5% management fee and the 16 to 20%, Pershing is about 2,400% since 2004, which is about 25x versus the 8x of the S&P 500. If you go, look, even minus all our fees, we crushing it up in Cheche. Okay. Yep. Then they showed this other graph where they said, now imagine that if we just had taken out 1.5%, it's up 45x, about 4,500%. So the reason they showed this is because they went, even with the 1.5% out, we still would have crushed. We're that good. What this triggered for me, if I were an investor in the fund before. So I was like, whoa, hold on.
You robbed me of all this.
Yeah, like you are showing me you've been showing me the capital that I have not been getting as an investor. That was my take. And I know that their take is, yeah, but you still made a whole lot of money. Like without us, you couldn't have done that. So I get that point. That's justification for the premium. I understand. And that is so sizable. The graph that I then want to see is now put the 1.5% back in. Like that's what but they don't have that graph. Just to be clear, they don't have that graph in here.
I have a strong take because you're doing what you do every week. You're just trying to poke my buttons and get me to yell about things. There are two people that I would sign up to pay ridiculous fees to in the history of my investing knowledge. Ed Thorpe and Jim Simmons. Those guys can have my money and basically charge me whatever fees they want. Everyone else should charge me a reasonable fee. Okay? Absolutely everyone else. Now, it's just excessive. It's one thing to say, listen, I'm Bill Ackman. My track record is great. I have this idea. I have a following. I am worth $100 million a year. It's one thing to say that. 1.5% is just excessive. It's not even necessary. It feels really greedy.
It's necessary. It's necessary. Here's why it's necessary, because they explain that. They explain why it's necessary.
Please.
Yeah.
Enlighten.
So they had a part of the presentation where they raised the question of Berkshire doesn't do this. Why would we, if we're calling ourselves Berkshire, the next Berkshire, why would we do this? Berkshire doesn't do it. And what they said is it's a different version of the facts that you just stated. They said you couldn't afford to pay us market rate. Berkshire Hathaway, they said Warren Buffett doesn't take a lot of money in salary. They say if you go look at Greg Abel, he takes a market rate of salary. He takes $10-20 million a year. I don't know exactly what it is, but they stated something like that. He gets paid that. That's his cash comp. You can't afford to pay us our market rate. So the only way that we can get paid, our management team can get paid the market rate to bring in these returns is to take a percent of the market cap.
According to Google Gemini, which I know is not the best AI model.
Greg Abel makes bananas.
No, Pershing Square Capital Management has 30 employees.
Yeah, it's something like that. Yep.
Okay.
Yep.
I understand that when you get to a certain level of wealth, the money isn't real anymore. The money is how you keep score with your friends, because it's not about being able to afford your groceries. Yep. I understand him saying, in order to keep score with my friends, I need X tens of millions a year.
That is not a good soundbite. That's not a good soundbite.
But that's what he's saying. And I am just saying, sorry, I'll drive down the California coast and see Ed Thorpe, because no, it's just not for me. Sorry, how can I say this more diplomatically? Just not for me.
Yeah. And I get that's how they justify it. They say Berkshire Hathaway, here's their model. Here's where I think, in addition to all the things that you're saying and thinking, here's what I think is the farcical part of it for me, is when you look at the size of Berkshire, they have now built $1 trillion in current market valuation, $1 trillion business. If you go back to 1964, 1965, or when he was first buying Berkshire to build it up, there's no way. Like, it's you reap what you sow. You don't reap your history. You reap what you sow in the future. And what they are doing right now with Howard Hughes is they are saying, look what we've done, look what we've done, look what we've done at the peak of a market. Sorry, when I say peak, I don't mean that the downfall is about to happen tomorrow. What I'm saying is that historically we are now at a peak. That peak could continue to rise. But we're at the peak of a market, at all-time highs in the market. Look what we've done. They go into their track record during quote-unquote critical periods. They said, great financial crisis. Guess what we did? We credit default swapped our way from $64 million to $1 billion. We can do that for you, Howard Hughes. COVID-19, $27 million to short, got $2.6 billion out of that. When interest rates were about to rise, we made $2 billion off that. What we can do, because Howard Hughes, you're in real estate. Macro is something you need to hedge against. You didn't do well on that. We do that really well. Value, value, value. Look at our cumulative returns. Value, value, value. You can't afford not to have us. And the only way you can afford to have us is this. And this is the most, in my eyes, antithetical Berkshire Hathaway thing you could do, because this is not a situation that's full win-win both sides, although they're trying to position it that way. This is a much more manipulative version of, what are you going to do without us? Nothing? Okay, then pay us buku wuku, Jim Simons type money.
Jim Simons charges a lot more, but he's worth it. Yeah. So was there any talk of the carry forward tax benefits? Because it looks like Howard Hughes lost $700 million in 2023. Like, I mean, I'm trying to give the benefit of the doubt here. There could be some really cool acquisitions and roll-ups, or like, we take this company. I mean, he's already an investor in Howard Hughes, so clearly he believes the long-term future is bright. But there's nothing else under the covers here of like, and this is why this is the perfect vehicle to build a holding company with.
Nothing that I at least wrote down or remember at the granular level that you're talking about. It was much more high level. Like for example, we mentioned last week the 3 different periods in the stock chart. He talked through more of that in this, so I can give like the high level. I'll give the very high level of that. That first period, he said Pershing was an open-ended hedge fund, so people could put in and take their money out as whenever they wanted. So when we hit tough times, which we did around 2015, there was a 30% drawdown. That's not good for us when we think about long-term capital. Then we had this hard time in the middle. They call it the challenging period for about 3 years, 2015 to 2018, where we converted to a closed-end fund, which is where Pershing is now, and they're calling that permanent capital, so they can think more long-term. And so if you can think more long-term, this is a great vehicle for us to do what we do best, is invest in public stocks. However, and this is where Howard Hughes comes in, he said, however, Pershing today really invests in large cap. There's an opportunity in small cap now, and we're going to use the Howard Hughes vehicle to look more at the small cap market, which has been underperforming, to make material either controlling or complete acquisitions in small cap. And this is a great vehicle for that. So it's more at the macro level, the high level aggregate that they discussed it, not to the extent that you just mentioned.
I mean, there's just a lot of companies with a $3 billion market cap with a price to book value of 1.4 and a debt to equity ratio of 2.
Okay, let me try this. Let me try this on you, because you're not. I'm going to convert you with this one. Also, in justifying the fee, he said it's really not that much money in the end. We're taking a material equity stake in you all, and like, that's what matters. It's the equity stake. For example, here are 2 examples. If Howard Hughes's price, the price of its shares, were to increase by 20%, our team's investment in Howard Hughes would grow by $260 million. That's what matters. The fees that we earn would only be $50 million. Like, that's not even like, why are you even talking about that? And if Howard Hughes's share price were to go down by 20%, pobrecitos, we would lose $260 million.
The fee's nothing at that point.
So don't even worry. No, they are. Don't worry about the $34 million we still make, because we just lost 260.
Yeah, I feel like I'm on an episode of Punked here. I think he also said something along the lines of, well, if we just take our $900 million investment and put it in T-bills, we can cover a lot of this fee. Didn't he say something like that? So like the fee's basically free. No, you're robbing the company of that $50 million that they could be investing. Like, they could be putting back. They could be buying the next company, since you want to buy all these small caps. Like, you could buy a nice small cap every year.
I have no doubt.
Doesn't make sense to me.
I have no doubt that Bill Ackman and his team can make Howard Hughes more money through them buying this 48% stake and using it as an investment vehicle in the future. I have no doubt about that. However, don't play this off with some analogy with Berkshire Hathaway. Just call it what it is. It is a opportunistic, capitalistic takeover of a company to use to line your pockets in the future. And I'm not saying that in a negative light. Like, just call it what it is.
His PR team won't let him do that.
Of course not. And he's a good marketer. Like, so All these, he has so many of these justifications, like, or what qualifications, I can call it justifications. Like he does say, we can take care of the macro, your real estate, you need macro. Look at historically what we've done. We can do that again for you in the future. We can increase your investor base because no one's looking at Howard Hughes today. They can't look at you and see you as a good investment. Look at us. We've got great media. We're good at marketing. You're going to have more investor interest. We can hedge so much better. Like it's right. These are not untruths, what they're saying here. They can do all those things. I go back to that cumulative return chart and say, can you fill those gaps? I don't like these gaps that you're showing me with these fees. If you want to talk about permanent capital, I want my capital to be permanently in the stocks that you buy, not permanently in your pocket.
Yeah, and like to that point, the market value point, if his team's worth $50 million, one, they already have another investing vehicle to pull off.
Yep.
Significant, probably $50 million. So really they're just making a new investment. Like they bought a ton of Nike 3 weeks ago. They didn't say now we need another $50 million. They're just adding to an investment they already have. So, but anyway, if that's the point, if my team is worth $50 million, then that should be a new expense item on Hughes Holdings or whatever it's called. They should get $50 million a year. And when they triple the stock, they should get $52 million a year.
The holding company can't afford that.
Yes, that's my point.
No, I know. But that's.
I think Ackman's. I don't know if I'd call him a great investor. I think he's a really good investor. Every time I look at his portfolio, there is quality finds in there.
I'm gonna try this. I'm gonna see if it works.
Okay.
The next time that I apply to an organization, I'm in an interview process, it's going well, and we start talking about compensation, I'm gonna pull up graphs of Doogles' historic performance and say, okay, let's take where you are now and just imagine it goes into the future. Obviously, I'm worth $30 million a year. And I know we just got our Series B. You can't afford that. So I'm going to go ahead and take
1% of revenue.
Yeah, I'm just going to go ahead and Kevin O'Leary you and take 1.5%. I'm going to take royalties. And if your stock goes down, oh, look, I also get hit because I own equity. I own that equity, but more power to them. As a capitalist, more power to them. Just call a spade, like so that we can look at the spade and make judgments on that. Do not compare this to Berkshire Hathaway. Charlie Munger will come back. He had to wait until Charlie passed to say something like this, because I would love for Charlie Munger to be in the comments. If he could log into X, if Charlie Munger could log into X, I would love for him to be in the comments.
So I wasn't planning on going to Omaha in May. I might have to go, because this will be a question to Buffett, and he'll go, "This is stupid," and we won't get the Charlie comment about just how stupid it is, saying that, his usual quip. But this is stupid. Doogles, I am flying high over here. All my China picks are blowing up. Doubled my investment on Baba. I am a prodigy, and this is hyperbolic by design. I am a prodigy with Chinese stock picks. I can do no wrong. So right now, I'm going to buy, or I wish I knew a good name, Yum China Holdings.
Okay.
All I need you to do is give me $5 billion. Then I'm going to take a 2% fee on that, because all my China picks, they crush. Look at my track record, right? I always double my China picks. Every single time I've ever held a China stock, it has doubled.
Meanwhile,
where's my $1 billion?
If someone wants to start an anti-Doogles China ETF, it would make so much bank.
It just
when we've discussed these China picks in like off pod, and we've done a little bit on pod, but off pod a lot in the past. And I just got to the point where I was like, I see Yum China looks so like, how could you not invest in this? Pinduoduo, like there are so many. It's like it just looks so good, but I can't because I have beaten myself with China so much. I'm like the antithesis of everything you just stated when it comes to China. I can only time poorly in China.
It just, I don't know if you planted this just to get me fired up or not. He's a great investor. he doesn't need an additional $50 million.
doesn't.
He just doesn't need it.
He
And
doesn't.
there's no real value.
No.
Yes,
'Cause
I know what his
the
presentation says for value add. There's no real value add here.
No,
He's
okay,
already a huge investor in Howard Hughes Corporation. You think he wants it to fail? Like, you think he's doing less good for that company?
What would be awesome here, in my view, is if all this was still happening and they just didn't take the fee. Like, you just say, look at what we've done. We can bring all this to you all. We're taking over a relatively small company, and we're going to build the legacy of Pershing off of this and build the next Berkshire Hathaway.
Mm-hmm.
And our incentives are completely aligned.
Because we own 48% of the equity.
Exactly. So like if we 10x this over the next,
I
don't know, whatever, couple decades, whatever it ends up being,
then our $1.5 billion or whatever it is goes to $15 billion.
Yeah, let's do that together.
We're the right resource to do that. Our team of 30 people is great.
I'm going to buy your car and say, I'm going to drive your car to New York, and I'm going to siphon 2% of the gas out every few miles, and hopefully we make it there. But look where I've driven in the past.
You did this to me on purpose. This whole show was just trying to get me mad.
Oh my goodness. It's fun to look at.
Well,
you got anything else?
Your new largest holding, is it HHH?
We're not going to discuss that on the show.
No, that's it. Guys, we're everywhere now. SkippyDoogles.com has everything. If you use the YouTube music player, subscribe to us over there, since we're getting that going too. And listener mail, skippydoogles@gmail.com. Talk to you soon.
Thank you.